Welcome back to the Dividend Diplomats YouTube channel. You know you're on with Bert, the Hurt, and Lanny, the Dividend Diplomats, baby. And we're here to talk to you about an undervalued dividend growth stock to buy that is down almost 40%.
Before we jump into this stock, everybody, smash that subscribe button. Give us that thumbs up. Smash that button as hard as the market smashed this company after earnings, because this company took a beating after it released earnings. And we are going to talk to you about this company, about their earnings release, and then run them through the Dividend Diplomats dividend stock screener in this video.
Now, you pretty much hit the nail on the head, Bert. You know, the S&P 500 already to start things off here in May has been very choppy. The wild swings. I know the Fed, you'll be watching this video on May 5th. So the Fed probably just announced, knock on wood, we'll see if they announced a 50 basis point increase or not. So the market has just been reacting wildly right now. Now that sent this dividend stock plummeting. And guys, we love when stocks go on sale. We love it when undervalued dividend growth stocks go down. Bert, what's a few reasons why you love the stock drops?
Because it gives you great buying opportunities to grab those undervalued dividend stocks that may have been trading at a premium in the past that are now at better valuations there. And plus, we are long-term investors. We don't care about the short-term blips in stock price. We look for companies that have shown their ability to grow their income over years and grow that dividend for years, for decades, and some 50 plus years. Yeah, that's those dividend kings. So when a stock drops like it did today, we are always interested because we're thinking 10, 15, 20 years into the future, not what's going to be happening over the next 2 weeks with this stock price.
Exactly. I mean, I've owned the stock for a while that we're about to talk about, but you're also buying a growing passive income stream for less than what it usually costs. I don't know about you guys. I think you guys like going to a store and finding some of your favorite things on sale. 20%, 30%. Again, we're talking about a stock, an asset that's on sale by about 40%. So, Bert, Rockwell Automation, ticker symbol ROK, today alone on May 3rd, dropped almost 15% or $36 in share price to $213.74.
Yeah, woof. That's all you can really say about that. When a stock drops that much, you have to take a look at it and see. And I think once we start talking about this earnings release here in a second, you're going to think it's pretty interesting, because in my mind, when I see 14% drop, I'm thinking terrible revenue, terrible income, terrible everything. I don't know if that's necessarily what happened here when we do the release. We know why it fell, but it wasn't for an obvious jump out reason like some of the other companies. Why don't you tell us a quick summary here of some of the things that happened, Lanny?
I mean, so what sent the stock down 15%? Was it the fact that total orders are up 37% year over year? Is it because sales are up 2% year over year and organic sales are also up? Is it because the total ARR is up over 50% with organic ARR up 17%? I mean, Bert, they're expecting sales growth guidance in the 11 to 15% range. Is that why the stock dropped? Is it because the board authorized a $1 billion share repurchase program?
Maybe, huh?
So what didn't you like about what they had in their earnings release?
Well, are you talking about me, or what didn't the market like? Because I think those are two differences here. Because what really drove the stock price down were not those great features and great highlights that you covered right there. Because yeah, all of those were positive. I saw what you were doing there, Lanny. They didn't like that downward adjustment of earnings per share guidance. That's what really tipped the market off. Yes, Rockwell's getting hit by inflation. They're getting hit by supply chain. So now, oh man, Mark, you're really going to hate this. They update that diluted EPS guidance Now they're only going to earn $7.60 to $8.20 during the year. Man, that's brutal that they're going to earn that much during the fiscal year.
So that's exactly it. It's management changed their guidance on earnings per share, which set the stock price tumbling because again, they were expecting, closer to $11 in earnings per share. So as soon as you adjust that down by $3 on that, oh yeah, it equates to about a 30% drop, which is exactly what we've been seeing year to date on Rockwell stock, down well over 30. I think it's 37% year to date.
Yeah, and there are so many other companies out there like, hey, welcome to the club, Rockwell. You too are adjusting your earnings guidance downwards. Like, hey, yeah, come into this line over here. You're always welcome.
Yeah, here's your beer, Rockwell. Take a sip.
Yeah.
So guys, now the question is, I own this in my portfolio and I'm curious now that the stock is down essentially $140+ from their 52-week high, down almost 40% year to date. Is it time to buy this silent but deadly dividend growth stock of Rockwell Automation now that that stock price has plummeted all the way down to below $215 per share?
Yeah, well, I don't know if everything was so silent this week because it was loud and deadly of what happened to them today in the market. So, Lanny, you're right. We're gonna figure that out by running them through the Dividend Diplomats dividend stock screener. 3 metrics, everybody. Come on, you know them by now. PE ratio less than the S&P 500, payout ratio less than 60%, history of increasing that dividends, and then we throw in that dividend yield. I can't wait to see what their dividend yield is about to be after a 14% fall today. Lan, you want to kick it off here? Why don't you run us through that first metric here?
Let's dive into the price to earnings ratio for Rockwell. So analysts are still expecting over that $10 in earnings per share. It may not have adjusted yet, but we're going to leave it in there. The stock price is $213.74. That PE ratio is about 20 times earnings. So kind of high still, don't you think, Bert?
Yeah, and especially when if they do hit the low end of that guidance, it's going to be even higher there if it drops down to 760. So interesting. Well, let's see how they perform through the rest of the screener before drawing any conclusions about Rockwell here. That annual dividend, the second metric here, is $4.48. Divide that by the 1066. That gives you a perfect payout ratio at the moment of 42.03%.
Obviously, that could change depending on what they actually end up achieving this year. It's pretty interesting, kind of Rockwell's case here, because they've been exploding that dividend up, going from, I think, just around $1 over the entire year back in 2010. Fast forward just a little bit over 10 years later, now it's over 400%.
Yeah.
Of what it, or close to 400% of what it was back then.
Yeah, earnings have grown too. That's why they're able to keep increasing that dividend so much. And I also think what's interesting here is let's just assume we put in that low end of the guidance of $7.60 for that EPS. Their payout ratio is still perfect. It's still below 60%. It's 58%. So even at the low end of that range, you have a perfect payout ratio.
Exactly. That's exactly why I'm watching, Rockwell stock. Exactly why this dividend stock should be on your guys' radar. Dive into that third dividend stock metric, the dividend growth rate. The chart's kind of skewed. It's hard to really see, without going back into the 2000s, but they've been growing it consistently for at least over 12 years. And if you look at the overall trend of Rockwell Automation, dividend trends up. And they've been doing that at an above inflation rate. I will say the word above, even though I know it's about 8.5%, but their dividend growth rate on average of the last 5 years is 8.2%.
Fantastic. Yeah, I mean, great metrics here for Rockwell. You hinted how much they've grown their dividend over the last decade. It's fantastic. Let's take a look at that yield, that bonus metric. Now that the stock price has tumbled, that yield is 2.10%. So the yield is pretty decently over 2%. I was going to say, I don't think it's quite there. It's a 10 basis points over 2, not too shabby.
So guys, in summary, right now, the P ratio on Rockwell's 20, payout ratio is at currently 42%. dividend growth rate over 8% for over 12 years with the yield over 2%. As we indicated, analysts online are still showing that $10+ in earnings per share. If we change that again, let's change that to 8. But if we want to make it 20 times, that means you're only at around $160 in earnings per share or in a share price. So the question is there still room to go down on Rockwell Automation? Bert, what's your take on Rockwell?
I think there is, and that's why at the moment I'm not going to be buying a Rockwell. I'm just going to be watching and seeing what happens here. I mean, you hit it on the head. I think there's still room to go down. Let's see what's going to continue happening with the market from my perspective. I'd like to see a lower PE ratio for myself regardless. There are other companies at lower multiples that I'm adding right now, such as your Cummins, such as your Stanley Black & Decker that you can see in our last video. So it's worth keeping an eye on, putting on the back end of my watch list, but I'm not buying at the moment. What about you, Lanny?
Yeah, until Cummins and Stanley just reduced their guidance next quarter. I'm good.
Oh, shocker. Stanley already did. They beat them to it, but I'm still buying. Not giving up hope.
It's too funny. Yeah, I'm on the sidelines right now, but Rockwell has caught my eye. Like I said, it's caught my eye. I'm not saying that, yeah, I'm putting dollars to it, but it's making its way to the dividend stock watch list that I have that I continue to monitor. I own them currently, so there's that. And I do like adding to my current positions, but I would like to see, what's crazy is if they drop into the 170s, you're talking about a stock price cut in half from where they were at their 52-week high.
Yeah, they'll be saying, thanks for holding my beer, Scott's Miracle-Gro.
Yeah, same boat, same situation.
Yeah.
So guys, what's your take on Rockwell Automation? Are you buying this stock right now? Are you going to wait until they drop below 200? Do you still see room for this stock to go down? If so, leave it in the comments. What other dividend stocks are you buying right now in today's volatile stock market?
And subscribe to our channel if you haven't already. Give this video a thumbs up. Thank you, everybody. Let's keep growing our passive income one stock at a time.
Come on, guys, grow that passive income like Bert said. Keep buying assets that produce income. Let's get on that journey to financial freedom. We owe it to each other. Let's get after it. It was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.